You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today, of course, is Wealth Formula Wednesday, and we are here with Zulfe Ali of Liability Group. Zulfe, as always, welcome back to the show.
Thank you, Buck. Great to be back again.
Let's start with this. Let's talk about this week's show. We had kind of I guess you would call it a serious nuts and bolts, blue-collar sort of show. We talked about liability insurance.
Yeah.
Anything to comment on that?
Well, I like when you do the nuts and bolts, content on your podcast. It's good because it just kind of makes sure that everyone goes back and thinks about some of the basic things that they have in place that, they might have done 5 years, 10 years ago, but it's time to refresh. I mean, I myself, after I listened to the podcast, I went back and looked at my umbrella policy. I put that in place, before my kids learned to drive, and now they're driving around, and that's a big liability. So I definitely have got a meeting scheduled with my insurance agent to up the coverage there. But again, it's just out of sight, out of mind. You put this stuff into place, and then you don't think about it. And I think having the opportunity to just someone kind of knock you in your head and say, "Hey, are you thinking about this?" I think it's great.
Did you feel like you kind of, anything strike you as something that you were surprised about or anything like that?
Well, I was really interested in the speaker talking about the insurance industry and, the challenges that they're going to go through as an entire market, right? She talked about the fact that they're now in a hard market. I guess I never really thought about the industry kind of going through that type of good markets and bad markets as a whole. I thought maybe insurers individually, some of them will be doing well, some of them won't be, but I thought it was quite interesting that if there's as a industry-wide issue that we're going through a hard market, well, if there's fewer policies being written, premiums are going up, insurance companies have depleted their reserves. That has a lot of implications for us, but from a personal perspective, our own liability coverage that we're doing as business owners and the insurance policies we take out, even as investors, right? Because we talked about in the past how insurance on multifamily in certain regions of the country is becoming very expensive and cost prohibitive in places. So I thought that was quite instructive, and I think it's an area that we need to think about more as we whether it's on a personal basis or business or investing.
Yeah, a couple things I would just add too is a big take home, and we didn't really talk about it on this show, but Doug Lodmell talks about from an asset protection standpoint, it is your first line of asset protection. You talked about umbrella insurance, which is like a big one, right? Like Doug advocates for really maxing out the umbrella insurance as much as you can. Like you're going to have some limitations, but if you can get like $5 million of umbrella insurance, he's like, it's cheap, get it. Because as you said, it's not just about your own liability, but it's like you've got kids driving around, accidentally, run over somebody's foot or something like that. And you've got issues. So I think it's easy to do. And some of those, insurance is always one of those things that it's like, it kind of sucks to buy it because, you don't know if you'll ever use it. But if you don't, man, it's an absolute mess. The other thing that I thought, I was thinking about during that conversation was how that liability insurance situation, particularly property insurance, has affected us. I mean, our portfolio. I mean, it has been that's been really, as much as, certainly interest rates have been the biggest thing, but the striking how expensive property insurance is getting, and actually there is apparently some potential limitation of that in DFW in particular because they've raised it so rapidly, and there is some lawsuits going back and forth in terms of real estate operators suing DFW for that. It is a big one. It's probably one of the biggest wild cards and something to consider going into markets and new markets, for example, and also something to consider in underwriting that if you're looking at underwriting for a new project, you want to make sure that the insurance considerations are taken very, very seriously. So that would be my other take. Otherwise, not a super sexy show, but it's good basics. But so let's go to the let's talk about the economy. What's going on with the economy? Anything new here? Are we still kind of,
Yeah, no, we're still, directionally heading the right way. The economy's growing, but not too fast. Employment's cooling, but not in an alarming way. We saw consumer confidence. I think that was the latest indicator that came out. Again, moderating very slowly. So
what does that mean? If it's consumer confidence is moderating, so you're saying that people are becoming a little less confident in the economy, and so they're less, and therefore they would be less likely to buy things. Or
that's right. Yeah, it's their propensity to spend. If they're feeling really good, they got a high confidence. They go out and they spend, buy lots of goods and services, max out their credit cards, all that kind of stuff. If they're not feeling as confident, then they tend to slow down. And consumer spending is a very, very large part of our economy in the U.S. It can be more than a third of overall GDP. So it's material.
There was also news in the real estate market, just in terms of residential home pricing, which I thought was really interesting, was that there was a new national price high, $419,000 in May.
Yeah,
it's kind of crazy to me, right? I mean, like, interest rates are still quite high, and mortgage rates are still high. So, what do you think? What do you think about this?
Well, that is the shocking part, right? Because interest rates up till even a few weeks ago were in the low to mid 7%. You would think that would have had a dramatic impact on killing the residential property market, but it hasn't. My feeling is that, people were thinking that interest rates coming down will help with affordability. That's not going to be the case either, because what's going to happen is prices are just going to go up higher very quickly. So, I think in general, the residential home market is just going to be out of reach for a lot of people trying to buy their homes, especially first-time home buyers that don't have equity built up in an existing property. It's very, very tough. And I think that's, it is a favorable backdrop for the rental market. Most people are just priced out of homeownership, and they're going to need to rent, and that's going to be the case for the foreseeable future.
Yeah, I was going to say is that it has that trickle down effect, right? If home prices are getting more expensive, it's going to push more people towards the rental market, and then as more people get into the rental market, that's going to probably drive up rent prices as well. Obviously, we're not seeing that necessarily right now. Which is good. We need the cool down here. We need rates to come down a little bit and so on. So that's all.
Yeah.
Good.
Yeah, and I think they are. I mean, we saw inflation. The numbers were getting more and more softer. So that's also helpful. By the way, Janet Yellen was out there getting quoted on making the same point that you'd been kind of reiterating over and over with respect to shelter prices and the fact that rental prices are really shown on a lagging basis. And so her statement was basically that she thinks that when you start seeing a lot of the contracts being renewed, which is happening now, that portion of inflation will dramatically, go down, which will help overall inflation levels, get to kind of 2%.
And that's a big component. I mean, it was like, I think the guy who was on the show, I forget his name, Campbell Harvey from Duke, was talking about how it represented like 70% of CPI.
Okay. Yeah, that's pretty significant. Yeah.
That's enormous, right? So like basically if he was showing, I think back then in real time, that even using the most optimistic levels of current rent growth that were available at the time, that CPI was just around 2%. And if you were actually looking at any other numbers, it was going below 2.
Yeah.
So if that's the case and CPI falls off a cliff, then our prayers for lower rates are going to be answered. So that's good news.
Yep. I think that's the direction we're headed. So let's see how things shape up. But overall, I mean, like we were saying, it's more continuation of the same of what we've been talking about. Markets in general are not materially changed. Equity indices are pretty much flat, maybe slightly down since last week, but every few days they seem to hit new highs and come back down a little bit and then hit new highs and so on. I think the interesting thing there will be to see if the tech giants keep contributing to that, to those increases, or if there's a bit of a pause in some of those share prices of those big companies, just because they've run up so far, so fast. You've got companies with $3 trillion market caps now out there, which is almost hard to imagine how big that is. But so I think that'll be an interesting thing to see over the summer and into the rest of the year, to see if those companies, if they keep gaining, or will it be a broader rally? Will some of the mid cap companies also join and participate in some of the upside in the shares? Certainly, if you had lower interest rates, a lot of those companies will benefit, because those companies tend to have more debt than the large mega caps. And so any kind of easing of interest rate environment helps their cost of capital, which helps their valuations. And so that can be positive there.
Gold, Bitcoin, all kind of like down. Bitcoin, I don't know what happened with Bitcoin. It was down like 5% or something, right? And it was kind of a bummer to see that. I couldn't really find any reason for it, but.
Yeah, same here. I can't find it either. I'm not an expert on Bitcoin, but it's been down the last 3 weeks now, about 5% each week. So it's I saw it was rallying earlier today, so maybe it's going to come back. Who knows?
All right, well, let's move on to the portion of our show where we talk about a little educational stuff, stuff that not necessarily stuff that I would talk about or know much about. It's more on the traditional side, where Valerity Wealth does their work. Well, you guys do alts too, obviously. That's why we're doing this. But let's talk today about money market funds versus money market accounts. What's the difference?
Yeah, no, absolutely. I think since we're going back to basics and we're talking about some elemental stuff, I figured we should make sure we hit some of the basics of investing. Currently, there's about $6.5 trillion of cash sitting on the sidelines, and they are sitting in various money market investments. And investors have been allocating a larger portion of their investable dollars to these types of instruments, which are earning around 5%. So I think investors generally feel like, okay, that's a good return on my money. I feel safe. There's no downside risk for me. Why do I want to risk it and go out in the markets and that sort of thing? So that's kind of what's happened. So, but as a result, we've got a record amount of cash just sitting there outside of being deployed. And I think a lot of your listeners, Buck, I'm guessing have some cash parked away in the same way. So I thought we'd do a quick review. First of all, make sure that, let's make sure everyone knows the difference between money market funds and money market accounts. Money market funds are investment products. So you can theoretically lose money on these. They're not guaranteed by the government. They invest in short-term debt securities. It's usually a mix of U.S. Treasuries, commercial paper that's issued by corporates. So they can have a mix of different types of securities from different types of issuers. They are generally considered safe. They're not very volatile. They trade at stable price. But again, they can lose money. And there's a good example back in the 2008 financial crisis when Lehman Brothers had filed bankruptcy, some money market funds were exposed to Lehman Brothers and they lost value. And what also happened was that people panicked during that time, and even if they had money market funds that weren't necessarily that exposed to Lehman Brothers, there was a run on money market funds, and that caused an incident known as breaking the buck. Has nothing to do with you, Buck, but buck as in a dollar bill. Most of these instruments are priced at $1 per NAV, meaning they're priced at par. Whatever the value is, that's what the price is. But they were actually trading below $1, so below $1's worth of assets. So that is pretty extreme in this market. They generally don't do that, but just so that investors are aware, if you have a financial crisis, if you have a shock, there can be a situation where even your money market funds might lose principal.
Well, in what
especially
case?
if you're trying to get out.
What would you use a money market fund for? How do you make money in those?
Well, the way to think about money market funds or money market account is really it's meant for a temporary parking of the cash. I mean, that's the way I think about them. They are not meant for long-term investing or even long-term parking of the cash. They're meant for a short-term horizon. Maybe you've got an investment that is paid out, and you're going to park the cash in a money market until your next investment comes, right? Maybe you've needed to draw some cash from somewhere, and you're going to close on a house within the next few months. You put it in a money market. It's going to be safe. Very likely nothing's going to happen to it that goes bad. You earn a little bit of interest along the way. So I think of it as a temporary situation.
How much interest do these typically have?
So money market funds, right now, anywhere from kind of 5 to 5.5% is what people are getting. Money market accounts, which are different than money market funds, they're actually savings accounts that are offered by banks. These are insured up to the FDIC limit, which is $250,000 per account. So you are guaranteed from the U.S. government not to lose that much of your principal. Anything beyond that, you're effectively, you're relying on the credit of your bank. And so, if it's a big bank, you're probably okay. If it's a smaller bank, you might think twice about that kind of exposure.
What's the interest in? Is it significantly different?
Yeah. They're like right now, you'll probably get somewhere in the mid to high 4% if you put it in a saving, money market account, savings account, and it's that difference, right? It's because you're insured, so it's safer, and then money market funds, you're not insured, right? And theoretically, you can lose money on that, so you get a little bit higher yield from that. Now, that being said, you should always remember that the yield on either of these instruments is really never going to exceed the rate of inflation, okay? And if you think about it, if you're making 5% in your money market account and you got a 30%, tax rate, you're getting 3.5% net. Well, where's inflation these days? It's 3.5%. So, in general, these types of investment instruments do not exceed the rate of inflation in terms of the yield that they pay. So you will lose money over the longer term if you stay in these types of securities. And you can almost think of it as a cash trap in the sense that you think you're making good money or decent return for the safety and that sort of thing. But in reality, if inflation is beating you out, you're actually losing money. So that's something that I think is more likely the risk that folks put their money in these things rather than actually lose principal because something crazy happened in the market. Yeah, that could happen, but that's something.
It goes to the principle. Robert Kiyosaki always talks about savers are losers. He says basically. He says they're losers, but his point is that they're going to lose money, period. Because if you're saving in the context of, if you're saving in the context of like savings accounts, things like that, anything below inflation, it's basically guaranteeing loss of buying power.
It's a 100% accurate way to look at it. It's just, you just basically, and again, you might decide that that's fine for you for whatever purpose, for the security that you want. Maybe this is money that you need to pay hospital bills or rely on, and you can't, on a short-term basis, you can't have the principal go down at all. Sure, I get it, right? You want to put it away where you just feel absolutely safe about it, and so that could be it. But we're right now in an environment where, as we just were talking through earlier, inflation is cooling. Short-term interest rates are likely to go down, and we're going to see those rates for money market securities and accounts. Those are going to go down as well. So, investors will have to face that decision sooner versus later. What to do with that, where to deploy it. And so, if you're an investor, you're out there, you're seeing something that comes across today that looks quite attractive, that you can lock in a good return or an expected return, you do want to take a bit more risk and keep growing that capital. As long as you've got a long-term investment objective. I'm not saying that this is appropriate for someone who needs the cash this year, but someone who is investing for the long term, you should be deploying that.
Yeah, I think the other thing to think about just for people in general is, if the point of these things is kind of like putting your money somewhere where it's not making less than 1%, like in a checking or savings account or whatever, that's also where some of the overfunded insurance stuff comes into what we call wealth formula banking, but overfunded whole life insurance policies. Same concept, basically. If your money's growing at 5-6% there while you're waiting, and then you can it's growing at a compounding rate, you are, if you want to use it, you can essentially borrow it from the insurance company for simple interest off their ledger. And so similar concepts, I think, like there's different ways to do this. And I think insurance is something else to consider in lieu of these kind of short-term, concerns about short-term, interest and that kind of thing. But all right, well, Valerity Group, of course, is there's Valerity Group, which is the broker-dealer, and then there is Valerity Wealth. Valerity Wealth is effectively the type of product that family offices provide their high net worth clients, which is an ability to have all of your personal finance needs under one roof so that they can be buttoned up, and to make sure that you're not missing something when it comes to asset protection, estate planning, your portfolio. You may want some advice. Some people are completely independent and say, I'm going to do all this on my own, but you could also, get some help from somebody like Zulfe, who's, done this for a sovereign wealth fund and kind of model what they do, which includes, by the way, a bunch of alternative assets. It's not like what Zulfe's doing is just stocks, bonds, mutual funds. It's more of a diversity play, but it's smart. It's smarter. It's sort of based on what ultra wealthy and family offices are doing. Did I miss anything there? Is that pretty good description?
No, that's a really good description. And like you said, we want to diversify portfolios, and we often get investors that have a very strong perspective that either they just want to do alternatives or they just want to do certain things. That's fine. We can work with that, and we can come up with strategies that fit your preferences as well. We'll always, give you advice that we think is best, and then we can also optimize things that meet your preferences as well. So.
Fantastic. Well, we will skip next week since it's the 4th of July, but we'll be back with everybody the week following for another episode with Zulfe from Valerity Wealth. That's it for this week. Thanks again, Zulfe, for being on the show.
Thank you.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.